Hey everyone, buying an existing business can be a great way to jump into entrepreneurship, but it's not something you want to rush into. There's a lot to consider to make sure you're getting a good deal and setting yourself up for success. In today's video, we're going to walk through 15 essential steps you should take when buying an existing business. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. Before you even begin looking for a business to buy, you need to be clear about your own goals. Are you looking for a business that aligns with your passion, or are you more focused on profitability? Are you prepared to manage a team, or would you prefer a more hands-off role? Knowing your goals will help you filter through businesses that fit your criteria. If your aim is to grow and scale, you'll want to look for a business with potential for expansion. If you're more interested in passive income, you might want a business that runs efficiently with minimal input. Once you have your goals in mind, the next step is to decide on the industry. Choose an industry that not only excites you, but also has long-term growth potential. Look for sectors that are trending positively and are likely to remain profitable in the future. An industry's growth potential is key to the long-term success of your business. If you choose an industry in decline, you may struggle to keep the business afloat, even if it's successful now. Focusing on a growing sector gives you a better chance of sustaining and growing the business. Before diving into any specific business, it's crucial to conduct thorough market research. Analyze the local and national market trends, competition, and customer demand. This will give you a clear picture of where the business stands within the industry. Market research helps you understand the business's position in its industry and whether there's room for growth. By identifying potential threats or opportunities in the market, you can better assess the business's long-term viability and avoid making costly mistakes. With your industry and market research in hand, start narrowing down potential businesses to buy. Look for businesses that meet your criteria in terms of size, location, and profitability. You can use online business marketplaces, network with brokers, or even reach out to business owners directly. Focusing your search helps you avoid wasting time on businesses that don't align with your goals. You'll also be able to compare multiple options and make sure you're choosing the business that offers the best value and growth potential. Once you've found a potential business, it's time to dig into the financials. Request financial statements from the past 3 to 5 years, including profit and loss statements, balance sheets, and cash flow reports. Analyze the company's profitability, expenses, and revenue trends. Reviewing the financials helps you determine whether the business is truly profitable and if it's a good investment. Look for any red flags, such as declining revenue or inconsistent cash flow, which could indicate underlying problems. Take stock of the business's assets and liabilities. This includes physical assets like property, equipment, and inventory, as well as intangible assets like intellectual property, customer lists, and brand reputation. Also, check for any outstanding debts or liabilities. Understanding the business's assets and liabilities gives you a clearer picture of what you're actually buying. It helps ensure that you're not inheriting more debt than you can manage and that the assets will support future growth. Evaluate the business's customer base. Next, take a close look at the business's customer base. Are they loyal, repeat customers? Does the business have a diverse client base, or does it rely heavily on a few key customers? A loyal and diverse customer base is a strong indicator of a healthy business. If a business relies too much on a few customers, losing even one of them could significantly impact revenue. Look for a business with stable, long-term customer relationships to minimize risk. Investigate the business's reputation. A business's reputation can make or break its success. Check online reviews, social media mentions, and customer feedback to gauge how the business is perceived by the public. Also, talk to current employees, vendors, and customers if possible. A business with a positive reputation will be easier to grow, while a company with a negative image may require more effort to turn around. Reputation is one of the most valuable intangible assets, so make sure it aligns with your goals and values. Understand why the business is for sale. It's crucial to understand why the current owner is selling the business. Are they retiring, moving, or facing personal issues? Or is the business struggling to stay profitable? the reason for the sale can reveal potential risks. If the owner is selling due to declining profits or industry challenges, you'll need to assess whether these are temporary issues you can fix or long-term problems that will affect the business's future success. Evaluate the business's growth potential. Consider the growth potential of the business. Are there opportunities to expand the product line, enter new markets, or improve operations? Also, think about how the business can scale in the future. A business with strong growth potential is more likely to deliver long-term returns on your investment. If the business is already at its peak or in a saturated market, it may be harder to increase profitability. Look for ways to improve the business and tap into new revenue streams. Analyze the competition. Take a look at the competition in the area. How many competitors are there and how strong are they? Are they growing or are they facing challenges that could benefit the business you're considering? Understanding the competitive landscape helps you assess the business's ability to maintain or grow its market share. If the competition is too fierce, you may struggle to differentiate yourself and attract customers. On the other hand, weak competition can create opportunities for growth. Review the business's employees and management. A business's employees and management team are critical to its success. Meet with key employees and managers to assess their skills, experience, and commitment to staying with the company after the sale. The current staff's knowledge and experience can help ensure a smooth transition. Losing key employees after the sale could create operational challenges, so it's important to gauge their willingness to stay on board and continue driving the business forward. Work with a lawyer to conduct legal due diligence. This includes reviewing contracts, leases, permits, and any pending legal issues. Make sure the business is in compliance with all relevant laws and regulations. Legal issues can become costly if not addressed before the sale. By conducting thorough due diligence, you'll avoid inheriting any legal liabilities and ensure that the business can operate smoothly after the acquisition. If you need financing to purchase the business, explore your options early on. Traditional bank loans, small business administration loans, and seller financing are all potential funding sources. Make sure to have your financials and business plan ready for lenders. Securing the right financing is key to making the acquisition feasible. Be sure to explore multiple funding options and choose the one that offers the most favorable terms. Having financing lined up before finalizing the deal will also give you more negotiating power. Once you've completed your due diligence and are ready to move forward, it's time to negotiate the terms of the sale. This includes the purchase price, payment structure, transition support, and any warranties or guarantees from the seller. Negotiating favorable terms can help protect your investment and ensure a smooth transition. For example, you might negotiate a lower purchase price based on your findings during due diligence or request that the seller provide ongoing support for a certain period after the sale. So there you have it, 15 essential steps you should take when buying an existing business. It's a big decision, but with the right approach, you can set yourself up for success and make a smart investment. If you found this video helpful, be sure to hit that like button and subscribe for more business tips and advice. Thanks for watching, and I'll see you in the next video with more money in your pocket.